A billionaire files his tax return. Line 24, total income tax owed for the year. The number $0. Not because he didn't make money, he did. Hundreds of millions, maybe billions in asset appreciation. But on paper, his taxable income, zero. And it's completely legal. Most people think the ultra-wealthy dodge taxes through offshore accounts or shady loopholes. The truth is simpler and more elegant. It's a three-word strategy that's been hiding in plain sight for decades: buy, borrow, die. You won't hear this at orientation. Your accountant probably won't bring it up unless you're already rich. But once you understand how this works, you'll see why the tax code isn't broken. It's working exactly as designed, just not for you. Let's break down the math that keeps billionaires from writing checks to the IRS. The first step is deceptively simple: buy. Not stuff, not cars or watches or things that lose value the second you own them. Buy assets, stocks, real estate, businesses, things that appreciate over time. This is wealth building 101. And most people get this part. What they miss is what comes next. When you buy $10 million in Tesla stock and it grows to $100 million, you've made $90 million. But here's the thing: you don't owe a single dollar in taxes, not yet, because you haven't sold. Capital gains tax only kicks in when you realize the gain, when you actually convert that stock back into cash. The IRS doesn't tax unrealized gains. Your net worth can explode, but your taxable income can stay at zero. That's not a loophole, that's the law. So the wealthy buy and hold. They watch their portfolios grow, and they never sell. But wait, if they never sell, how do they pay for anything? How do they buy houses, fund lifestyles, invest in new ventures? They can't just sit on illiquid assets forever. That's where the second step comes in: borrow. Here's the move most people never see coming. Instead of selling $10 million in stock and paying $3 million in capital gains tax, the wealthy use that stock as collateral and borrow against it. Banks love this. It's a secured loan. The interest rates are low, often 2 to 4%, because there's zero default risk when you're backing the loan with $100 million in assets. Let me walk you through the numbers. Say you need $5 million to buy a property. You could sell $5 million in stock, pay $1 million in capital gains tax at 20%, and walk away with $4 million after tax. Or you could borrow $5 million at 3% interest, keep your stock intact, and pay $150,000 a year in interest instead of $1 million upfront in taxes. The math isn't even close, and it gets better. Let's say your stock portfolio grows at 8% annually, roughly the historical average for the S&P 500. You borrow $5 million against $20 million in holdings. That's a 25% loan-to-value ratio, which banks love because it's conservative. Your $20 million grows to $21.6 million in year one. You've made $1.6 million in unrealized gains while paying $150,000 in interest. Net position, $1.45 million ahead, tax-free. If you'd sold instead, you'd have paid $1 million in taxes up front, lost $5 million in market exposure, and missed out on $400,000 in growth on that sold portion. The opportunity cost of selling isn't just the tax bill, it's the compounding you give up. And here's the kicker: if your assets grow faster than your borrowing costs, which they often do over long periods, you're essentially getting paid to stay in the market. The interest is a fee for liquidity. The growth is your reward for patience. That $150,000 in loan interest, often deductible. The stock you kept, still growing. If it appreciates another 10% that year, you've made $10 million in unrealized gains while paying $150,000 to access $5 million in cash. You've effectively gotten liquidity without triggering a taxable event. This is how billionaires live. They don't have income in the traditional sense. They have assets, and they borrow against those assets to fund everything. No sale, no capital gains, no tax bill. Now, here's the part that separates this from a temporary deferral strategy, because eventually you'd think the tax bill comes due, right? You can't borrow forever. At some point, you have to sell, realize the gains, and pay the IRS, except you don't. That's the third step: die. When you die, your heirs inherit your assets. And here's where the US tax code does something remarkable. It gives them a step up in basis. Let's say you bought stock for $10 million decades ago, and it's now worth $500 million. You've never sold it, you've borrowed against it your whole life, you die. Your kids inherit that $500 million in stock, and their cost basis isn't $10 million. it's $500 million. The IRS resets the clock. All that appreciation vanished for tax purposes. Your heirs can sell the stock the next day and owe zero capital gains tax, or they can hold it, borrow against it, and repeat the cycle. The tax bill you deferred for 40 years, it never comes. It evaporates. Think about what this means. If you'd sold that stock yourself and paid the capital gains tax, the IRS would have collected $98 million at 20%. But because you held until death, your estate might pay estate tax, which only kicks in above $13.61 million per person as of 2024. But your heirs get the step up. They inherit $500 million with a fresh basis of $500 million. They can turn around and sell it all, pocket the cash, and the IRS gets nothing from the capital gains. The estate might owe estate tax on amounts above the exemption, but that's a separate calculation. And with proper estate planning, trusts, gifting strategies, charitable donations, wealthy families minimize even that. This isn't some fringe theory. It's how generational wealth is preserved in America. Buy appreciating assets, borrow against them for liquidity, die and pass them on with a clean slate. The system isn't designed to punish wealth. It's designed to protect it. Now let's talk about why this works and why the tax code is structured this way in the first place. The argument from policymakers has always been, we don't want to tax unrealized gains because it would force people to sell assets just to pay the IRS. It would destabilize markets. It would hurt innovation. It would punish long-term investing. And to some extent, that's true. If you taxed unrealized gains, you'd force liquidations, you'd create volatility. But the side effect, intentional or not, is that people with massive asset bases can live their entire lives without paying income tax. Meanwhile, someone making $100,000 a year in salary pays taxes on every dollar before they even see their paycheck. There's no deferral, no step up, no borrowing strategy, just income tax repeat. The gap isn't about effort or intelligence. It's about structure. One system taxes income, the other taxes realization. And if you never realize, you never pay. This is why you see periodic proposals to tax unrealized gains or eliminate the step-up basis. Politicians point to billionaires paying lower effective tax rates than teachers and firefighters. They're not wrong. In 2021, ProPublica analyzed IRS data and found that the 25 wealthiest Americans paid a true tax rate of just 3.4% when you factor in wealth growth. But here's the problem. Changing this system is nearly impossible. First, taxing unrealized gains would force asset sales, which could crash markets. Imagine telling every billionaire they owe 20% tax on paper gains every year. They'd have to liquidate positions just to pay the IRS. That's not a hypothetical concern, it's a structural risk. Second, the step-up basis has been in the tax code since 1921. It's survived a century of reforms, recessions, wars, and political shifts because it's deeply embedded in how Americans think about property rights and inheritance. Touching it is political suicide. And third, the people who benefit most from this system are the same people who fund campaigns, lobby Congress, and shape tax policy. The incentive structure protects itself, so while you'll hear proposals to tax the rich every election cycle, the fundamental architecture rarely changes because the people who understand it best are the ones who need it least, and they're not interested in dismantling it. This is the incentive structure baked into the U.S. tax code. It rewards asset ownership over labor. It rewards patience over liquidity, and it rewards scale because borrowing against $500 million in assets is a lot easier than borrowing against $50,000. Let me show you what this looks like in practice. Take someone like Elon Musk. In 2021, ProPublica reported that Musk's wealth increased by $13.9 billion, but his reported income was so low he paid zero federal income tax that year, not because he cheated, because his wealth is in Tesla stock. He doesn't take a salary. He doesn't sell shares unless he absolutely has to. When he needs cash, he borrows. In 2020, he took out personal loans worth billions using his Tesla and SpaceX shares as collateral. He didn't sell. He didn't trigger capital gains. He just borrowed at low rates and kept building. The interest rate on those loans, likely under 3%, far below the long-term appreciation rate of his holdings. So even while paying interest, his net worth grows faster than his debt. He's effectively arbitraging the spread between borrowing costs and asset growth. And when he eventually dies, his heirs will inherit those shares with a stepped-up basis. Decades of appreciation tax-free. This pattern repeats across the Forbes 400. Jeff Bezos, Larry Ellison, Warren Buffett, they all use variations of the same strategy. They hold massive equity positions, borrow against them when they need liquidity, and minimize taxable income. Buffett famously pointed out that he pays a lower tax rate than his secretary, not because he's evading taxes, but because the system treats capital gains and carried interest fundamentally differently than wages. This isn't illegal. It's not even unethical by the standards of the current system. It's just the logical outcome of a tax code that treats capital and labor completely differently. Now, here's the question most people ask when they hear this. Can I do it? The short answer is yes, but only if you have the assets to make it work. You can't borrow $5 million against $50,000 in a retirement account. Banks won't lend to you at 3% if your collateral is a diversified ETF portfolio worth $200,000. The scale matters, the liquidity matters, and the asset class matters. But the principles, those apply at every level. If you own a home and you take a home equity line of credit instead of selling and downsizing, you're doing a version of buy-borrow. If you hold index funds in a taxable brokerage account and avoid selling until you absolutely have to, you're deferring capital gains. If you pass those assets to your kids someday, they'll get the step up. The strategy scales. It just scales better when you have tens of millions instead of tens of thousands. Let me give you a middle-class example. Say you're 50 years old with $300,000 in a taxable brokerage account and a paid-off house worth $500,000. You want to help your kid with a $50,000 down payment on their first home. Option one, sell $50,000 in stocks. If you bought them for $30,000, you owe capital gains tax on the $20,000 profit. At 15%, that's $3,000 to the IRS. Your kid gets $47,000 after tax. Option two, take a home equity line of credit at 6% interest, borrow $50,000, your house is collateral. You pay $3,000 a year in interest, but your $50,000 in stocks keeps growing. If they appreciate 8% that year, you made $4,000 on money you didn't sell, net ahead. $1,000 plus you still own the stock. Over 10 years, if your stocks double, that $50,000 you didn't sell is now worth $100,000. If you'd sold, you'd have missed that growth entirely. The interest you paid was the cost of staying in the market. And when you die, your kid inherits the portfolio with a stepped-up basis. This isn't billionaire-only math. It's the same logic, just smaller numbers. The principle is identical. Hold assets, borrow for liquidity, let time do the heavy lifting. So what's the move here? What can you actually do with this information? First, understand that wealth in America isn't built by earning more income. It's built by owning assets that appreciate and holding them as long as possible. The tax system rewards this behavior. Use it. Second, if you have assets, stocks, real estate, anything with equity, think twice before selling just to access cash. Look at borrowing options. HELOCs, margin loans, securities-backed lines of credit. The interest might be cheaper than the tax hit, especially if your assets are still growing. Third, shift your focus from income to ownership. Every dollar you can redirect from taxable income into assets that appreciate tax-deferred, whether that's index funds, real estate, or something else, moves you closer to the structure the wealthy use. And fourth, plan for the step-up. If you're holding long-term assets, understand that the longer you hold, the bigger the tax advantage for your heirs. Estate planning isn't just about avoiding estate tax. It's about maximizing the step-up basis. Is this going to turn you into a billionaire overnight? No, but it's the same framework billionaires use, just at a different scale. Now here's the part nobody wants to say out loud. This system works because it's designed to work this way. The tax code isn't broken. It's not full of accidental loopholes. It's the result of decades of lobbying, policy decisions, and incentive structures that favor capital over labor. The step-up basis wasn't some oversight. It was a deliberate choice to encourage intergenerational wealth transfer without punishing asset holders. And the borrowing strategy, that exists because banks make money on secured loans, and wealthy clients are low-risk, high-margin customers. Everyone wins except the person paying taxes on their paycheck. You can be frustrated by this, or you can understand it and adjust your strategy accordingly. The people who build serious wealth in America don't fight the system. They study it, they use it, and they structure their finances around the incentives that already exist. Buy assets, hold them. Borrow for liquidity. Pass them on. That's the playbook. It's been working for a century, and until the tax code fundamentally changes, it'll keep working. So here's your move. Start thinking like someone who owns assets, not someone who earns income. That shift, that one reframe, changes everything. Because once you stop selling and start holding, you're playing a different game, one with better rules. The system is designed to reward you for waiting, for holding, for leveraging instead of liquidating. Most people never figure that out. They earn, they spend, they pay taxes, and they wonder why they're not getting ahead. Now you know why. And more importantly, you know what to do instead. Subscribe if you want more of this, the numbers, not the slogans. And tell me in the comments, what's the biggest tax myth you believed before you understood how the system actually works?